Welcome, everyone. Welcome to Appella Academy and our most recent webinar today, where we're going to catch you up on this past quarter's worth of happenings in the stock market. As many of you know who have been paying attention, there's quite a bit to cover over the past quarter. Before we get started, just wanted to say thank you. All of us here at Appella are so thankful that each and every one of you join us for today's event. It's really our privilege to provide what we hope is welcomed financial planning and investment education. We are recording today's webinar, as we always do, and you've heard me say this before. We really want you to share this with friends and family, really anybody who might find this interesting, informative, helpful, etc. If you've missed any of our previous webinars, I would encourage you to go, or to tell your friends to go to our website. Check out the events page. Our most recent webinar is posted up there, where we talk about navigating major life changes with financial confidence. And that was led by some of Appella's finest advisors, Evelyn Zolan, Julie Hurd, Ross Richardson. Great webinar. If you missed it, please go check that one out. All of our future webinars are also listed on there. If you have questions throughout today's presentation, please use the Q&A function. I will be monitoring that throughout, and if we can get to your question at a time that makes sense, we will do it during. If not, we'll try to get to some at the end. If we don't get to your questions, we'll do our best to reach out individually and answer any and all of those questions. So we would encourage you to please ask a question and leave your name, just so that we know who we should be addressing that question to. All right, with all that said, it's time to welcome everyone's favorite guest speaker, Apollo Lupescu. Apollo is Vice President, Dimensional Fund Advisors, which is one of the world's premier investment managers. For those who have not seen Apollo speak in the past, well, shame on you, first and foremost. But you're in for a treat, right? Apollo not only is a great friend to the firm, but he has an incredible knack for breaking down some of the most complicated topics and making them understandable, and better yet, enjoyable. So welcome, Apollo. Great to have you back.
Hi, Jason. Thank you so much for the kind words, the invitation to come back, and thanks to everyone for taking the time this afternoon to join us. I'm excited about our conversation. There's a lot that has happened since we last chatted.
Yeah, and we're going to try to relive as much as possible of the past 3 months. And
the good parts, the good parts.
The good parts, yeah. We're actually at the halfway point of the year, slightly beyond now at the time of recording this. It's been a crazy, volatile year for investors. Significant swings in each direction. So, I was thinking about what does it look like for a diversified investor today? Because it might feel worse than it actually is. So maybe you could take us through where we are thus far in the year and any lessons we could glean from that.
Right. And as you said, there was just so much that happened. And if you look at the first quarter of the year, that did not look good. I think, a lot of folks came in the year kind of hoping that perhaps a new administration would provide some deregulation, maybe some tax relief, and perhaps on those hopes, the market had gone up late last year. But at the beginning of the year, as we start talking about tariffs, and that became such a central topic in the national conversation, the first quarter actually was negative. The S&P 500 was down about 4% or so, 4 to 5%. And then the second quarter, as these tariffs kind of got put on hold, it just came back roaring to the point where for the first half of the year, the S&P 500 is up about 6.2%. So folks, a very good news to report is that this year has been good to investors, despite all the noise that you hear out there, despite everything. It has been a very good year for investors, and let's not lose sight of that. So it's good news to report. The markets are up. You have made money this year in the U.S. stock market. But when we're talking about this S&P 500, this is an aggregation of 500 different companies. And it turns out that if you look at the first 6 months, not every company made you money and not every company lost you money. It's a balance. And that balance for the first half was about 59%. About 60% of the stocks in the S&P were up for the year. Their value increased, and about 41% saw a decrease in value. So again, the good news here is that you know more stocks that made money than lost money. And the obvious question is, can you figure out a pattern that will tell you which companies, what sectors might go up or down? And we've looked at this, and the reality is that it would be disingenuous for me to tell you there's a way to do that. It's just very random. And just to give you some ideas, you take two clothing companies, Ralph Lauren and Lululemon. Well, Ralph Lauren was up significantly, 30% or so, and Lululemon was down over 30%. So, you know, they're the same business. You look at Ford and GM. GM was down, Ford was up. And probably the ultimate example is Coke versus Pepsi. Coke was up for the first 6 months, Pepsi was down in the negative category. So there's no real way to tell. And that's why it's so important to kind of hold all of these companies. And if you actually take a bit of a more, you know, a closer look at the magnitude of these returns, it actually gets quite interesting, because what you see is that the most number of companies, 123 different stocks, had returns between 0 and 10%. And that's the majority of the stocks on 123. And then about 104 of them had returns between negative 10 and 0. In other words, we see a pattern that is consistent with just long-term data in the US, that the most frequent observation, the largest number of companies tend to be around sort of the middle values of the returns. And the more you go to the extremes, either negative or positive, the fewer and fewer of these outcomes do we see. So in the context of extreme outcomes, we did have two extreme outcomes that were below 40% loss in value for those stocks. The good news is also we had about 23 different companies that had over 40% in gain. So a lot, it's again, it's better to have more on the right-hand side than the left-hand side. And that's exactly what we see. 23 different stocks had over 40% returns. And if you're curious, what was the best performing stock for the first 6 months? It is a Silicon Valley company called Palantir. They do a lot of national security contracts and so forth, using you know, computers to decipher the signal from the noise, if you want to think it that way. The worst performer, it was a company that you might be familiar with because of their products. The company is called Decker Outdoors, and the products that you are familiar with are probably Hoka shoes and Uggs, among others. So again, hard to kind of have said that Hoka is going to go down and shoes are no longer in style, and now you got Palantir in style. But you know, ultimately, Jason, we go from 500 different results, 500 different stock performances, to a single number. And the question is, how do we get there? And it's not just looking at the individual performances of the stock, but for all of it, it's really important to know that in order to measure this performance, we also have to look at the size of the company. How meaningful is the value of the entire ownership of that company relative to others? And the larger that size of ownership, the value of ownership, well, the greater emphasis we put on the performance of that stock. And that's why the size of the stock really matters in the way we measure performance. And what's really interesting is that you have these companies that have become known as the Magnificent Seven. And these Magnificent Seven are some of the largest stocks in the US stock market. And you know, they're the usual suspects, the Amazon, Microsoft, Nvidia, Tesla, Facebook, Google, and Amazon. And what's fascinating is that if you take these companies aside, last year they did twice as well as the stock market as a whole. They really crushed it. They did incredibly well. And what we advise people to do is, like, it's good to have them, but just be careful not to overemphasize them, because there might be times when they might not do as well. And it turns out that actually this was pretty good advice for this year, because these seven stocks on average were up only about 2.7%, so less than half of the market returns. And they left a hole in the S&P. So if you look at the S&P 500 minus the 7, let's just call that the S&P 493. The remaining on the stocks in the U.S. market actually did really well, 8% despite all the noise that you've heard. So it's a bit of a tale of different tale from last year when these Magnificent Seven drove the market higher. This year they actually pulled it back, and the reason they had such a big impact from 8% down to 6% is because these seven stocks alone amount to roughly about 1/3 of the value of the entire S&P. 1/3 of the performance of the S&P is driven by seven stocks. And that's quite a bit. And what's fascinating is that the same exact seven stocks are also part of a different metric called NASDAQ, but not at 33%, rather 53%. More than half of the value in NASDAQ is in seven stocks. More than half of the performance of NASDAQ is driven by seven stocks. So that's quite a bit, if you ask me. So that's why Nasdaq actually didn't do as well as the S&P. And what we advocated, Jason, last time is not just to look at U.S. companies, but have a global perspective to investing, where you still hold these seven stocks, but instead of 53 or 33, it would only be maybe less, maybe around 18% in a global perspective. So you're not emphasizing them as much. And once again, this paid off really well for investors this year. So long story short, Jason, really good news to report in the U.S. market, not universally across the board, but by and large, we had a good year. And for people who stayed disciplined and diversified, it was really a good outcome for the first 6 months of the year.
It's interesting. You mentioned earlier, just a moment ago, actually, global stocks, right? And it's a representation of the Mag 7. For a long period of time, what we've seen as investors is the U.S. outperformance of global non-U.S. stocks, international, developed, emerging markets. I think what surprised a lot of investors in terms of their performance this year was, the world seemed to be burning maybe a little bit, but international and emerging started to do a little bit better. Could you take us through non-U.S. performance and maybe how we should think about that going forward?
Yep. So to think about international developed and emerging, which is basically that's there's a little jargon that reflects the categories of stock markets. International developed are countries that have a fairly robust judicial system and just in general, it's a pretty robust society that is stable. And then emerging markets are countries that still trade freely, but they just not as there's something associated with them that doesn't make them as solid as, for example, international developed. So if you look at the companies, they can be based in any country. And if you redraw a world map based on the value of companies that you can buy and sell in different parts of the world, this is where it gets interesting. The US is roughly about a quarter of the value of all the economies in the world. So the US economy is about 25% of the world economy. But when it comes to the stock market, if you redraw a world map, what you see is that the US, in terms of the 3,000 plus companies in which you can buy ownership, it is quite significantly more than 25%. It's about 65%. And that's because some of the companies that trade in the US, like Apple, Google, Facebook, and so forth, they're global companies. They're selling their products all around the world. And that's why, even though the size of the economy is only 25%, US is the largest chunk. International developed reflects UK, Germany, Switzerland, Australia, Japan, Canada. We know those countries. And emerging markets are more like China, Korea, Taiwan. And roughly speaking, what an advisor would do would just look at these percentages and say, as a starting point, if I were to think how much to allocate to US stocks versus Japanese stocks, well, a good starting point would be to look at these relative weights. And in that respect, typically US carries the greatest weight, followed by international developed, and that's typically, that's something that Appella would kind of be very careful in deciding the weights. But it's probably in the neighborhood of about 20% or so, and emerging markets roughly about 10. But that's something that they decide. You kind of get a sense of how the money's allocated. And for the first half of this year, so if you look at the first half of 2025 at stocks, as I said, the US and it was roughly about 6% if you look at the S&P. Now, international developed has its own metric, and that metric was up roughly about 19%, significantly more than the US. And emerging markets, MSCI, which is the benchmark that we use, it's about 15% up. So really a remarkable performance for these international and developed markets. And if you're balanced among the three, had you a portion to the US, a portion to international developed, and a portion to emerging, your results in stocks for the first 6 months would have been even higher than 6%. And just to give you just a yardstick, the long-term average in the US has been about 10%. So the US stocks returning to 6% is roughly the long-term average. But for international developed and emerging, it's way above the average for the entire year. And again, we're only halfway through. So very good results abroad. And this is in contrast to what happened last year when international developed and emerging did not do as well as the US. But as we counsel, it's probably good to stay diversified and disciplined rather than try to chase what did well up until yesterday.
If we think about the global marketplace and countries specifically, it's hard to talk about that without bringing up the topic of tariffs.
Right.
That kind of soon as Trump took office, he really started making good on his promise to implement tariffs, suspended them, and they're coming due again soon. So as we kind of think about where tariffs were, are, and could be in the future, what are the implications of tariffs moving forward, and how should investors think about the potential impact to markets and volatility that they might see on the horizon as the suspensions are over?
Absolutely. Well, let's start with just a quick observation. I just not long ago, I had a meeting with a family, and this really incredibly nice and sophisticated gentleman basically was suggesting that tariffs are a fine that the U.S. is imposing on foreign producers who are trying to sell to our citizens and then steal our jobs. And to some degree, I wanted to almost kind of demystify a little bit what tariffs are. So I'm wondering if to some degree it's worth kind of touching on what exactly is a tariff and how does it work so we can understand better what the consequences might be. Is that worthwhile? Or do you think the folks out there have a pretty good understanding of how tariffs actually work in the real world?
I think it's always a good idea to do a quick refresher on
Yeah.
them, because I do think that it is one of the things via the news, social media, that it does get a little murky
Yeah.
in how they're implemented and what they really are.
Yeah, so let's just clarify it quickly. So I'm going to use an example that is near and dear to my heart. I'm not Buddy the Elf, but I do love maple syrup. I don't put it on spaghetti, but I put on yogurt and a lot of things. And let's say that I buy it at Costco, and Costco wants to sell maple syrup. So what Costco does is they go to the Vermont producers and they say, "Well, I'd like to buy you maple syrup." Great, we'll sell it to you. And then they realize that, boy, we need a lot of maple syrup and a lot of trees across the border in Canada. So they also go to the friendly Canadian producers and say, listen, I'd like to buy you maple syrup. And those friendly Canadian producers say, sure, I'll sell it to you for, let's say, $20 a bucket. And then Costco adds a few bucks for their warehouse, the employees, the profit margin. So let's just say they add another $5 and I can go pick it up for $25. That's the good old days with no tariffs. But now President Trump comes along and said, no, 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 we're going to charge 25% tariff of everything that comes from Canada. And let's say maple syrup is included. So how does it work now? Well, the entity legally responsible for sending the government a check in the value of 25% of what is brought in the country is the importing company, in this case, Costco. So Costco is legally responsible to send the government a check that is worth 25% of what they bring in. So if they brought in $20 worth of maple syrup, they have to send the government $5. Now, where is this $5 going to come from? One option is Costco goes to producers and says, listen, friendly Canadian producers, I have to send the government $5. Why don't you sell me the maple syrup for $15? So by the time I send the government the check, nothing changes. And those producers say, wait a second, little Costco, that doesn't work that way. It costs me more to make it. Plus, where else are you going to get maple syrup? It's not like you can plant a tree and get maple syrup tomorrow. No, this is what we sell it for. Take it or leave it. And given that there are no other options, Costco say, fine, I'll have to pay the price that you want. So they buy it at $20, but they still have to send the government $5. Another option is that they could send their own $5 to the government, but that's not a feasible business. And the third option is like, well, I could increase the price and take the additional dollars and send that to the government. And that kind of gives you a picture of how complex these tariffs are, because even though Costco is legally responsible for sending the check, there are three parties involved: the producer, the importing company, and the consumer. And the producer by no means is forced to pay the tariff. Not at all. If the producer doesn't want to lower their price, they don't have to. And this, a lot of times the importing company might want to negotiate with them. Please cut a little bit so it doesn't get too bad. But it's not at all forced to do that. And what we saw last time when President Trump imposed tariffs, I think there was a study that looked at the washing machines, and there was a 20% tariff on washing machines. And what economists saw is about 12 out of the 20% was passed on to consumers in the form of a higher price. And the rest were haircuts that the producers and the importing company did. So that's why, folks, you might have heard quite a bit about the potential for inflation, because these tariffs are likely to be passed to a certain degree to consumers, for some products more than others. And that's where it gets complicated. I can't tell you there's a formula for each product. If a lot of things are being made abroad and there are no alternatives, it's going to be very hard for the importing company to negotiate. On the other hand, if everything's made here and there's this one lone producer, it's probably going to be different. But at least at this point, given the dynamics of the global economy, it is quite likely that the products are going to go up. And there's a lot of warehouse inventory that's now being depleted. And as they need to replenish that, it's quite possible that prices might go up, selection might go down, or quality might go down. Who knows? But what's important to know is that the companies, the importing companies and the producers, they're going to try to figure out a way of how do I make up the lost revenue. And in the case of the washing machines, what they did is they basically said, well, what goes along with a washing machine? A dryer. So even though dryers are not subject to tariffs, they actually jacked up the price to make some of it up. This time around, it could be that free shipping might not be available, so prices don't change, but you don't get free shipping anymore, which in effect is also a price increase. So that's where it gets really complicated to kind of distinguish. But by and large, I think that the biggest impact is likely to be on the American consumers and paying more and probably less variety. But it depends on product by product. Now, as an investor, this is where it gets interesting. There are three things that we see happening. The first thing that we see happening is that the market is paying very close attention to policies and what to expect in terms of policy. And we see that even before a policy is adopted, the stock price adjusts to reflect the expectation of good news or bad news for investors. And all the volatility that we saw during the year because of tariffs, that's actually a really phenomenal thing to see, because the markets were adjusting to the unexpected news that were coming out. And that's exactly what you want to see. If somehow a policy is going to be bad long run for a company, well, the value is not as high, price is going to drop. That's exactly what we saw. The second thing that we see is that the stock market, by and large, and any one company, none of their results are driven solely by tariffs. In fact, tariffs is not a primary driver of market performance. And the third element is that companies will try to figure out, how do I navigate what's put in front of me? So let's illustrate with some case studies, Jason. If you look in the first Trump administration, they were putting tariffs on steel, or at least they kind of talked about putting tariffs on steel. And there's a company that carries the name of the industry, and that's U.S. Steel. And as the administration came in, the stock price went from $40 a share to about 20, lost about half its value in a fairly short time. And then the administration started talking about perhaps imposing tariffs. No clarity that they would, but perhaps on that expectation, you saw a big increase in the stock price of U.S. Steel, even though there was no clarity that tariffs will ever come along. It's just the expectation that was priced in. And it turns out that in March of 2018, we did see tariffs actually come in. And at that point, as an investor, you might say, great, now you have the government backing you up, so must be milk and honey for investors. Well, what happened between March of 2018 and when the administration lost the election in November 2020 is that U.S. Steel lost the vast majority of its value, despite having the tariffs to back it up. So if tariffs were indeed the primary driver of a performance, it's unlikely that we would have seen this. So cautionary tale there, prices already adjust in advance based on the expectation. But generally speaking, even if you look at the market as a whole, it is not that the first time that we see all the trade war and tariff talk, because if you go back to the first Trump administration, pretty much the same noise. And if you look at the S&P 500 over those 4 years, there was, during which we saw so much talk about trade and tariffs and trade wars. It turns out that the U.S. stock market did very well. $1 invested at the beginning of the administration grew by 80%. 80% growth on your money in 4 years, despite all this tariff talk. So that's not bad. That's actually a really nice result over those 4 years. But perhaps there's something about not investing in countries that are the target of our tariffs. And obviously, China was a big one. And if you look at the Chinese stock market over the exact same 4 years, it did not go up by 80%. In fact, it went up by 100%. It outperformed the US market despite being the target of tariffs. And you look at this year, I mean, this is fascinating. If you look through the end of June, the US is up about 6%. And you look at China, China is up roughly about 18% year to date, 3 times as much as the US. Those Canadians with maple syrup that we like so much, they're up about 16%, quite a bit more than the US. And our Mexican friends down south, they're up about 30% in their stock market returns. And even Germany, who is so dependent on trade and exports, their stock market, despite all the tariffs, it's up 35%. So if
Hmm.
indeed tariffs were such a major determinant of market performance, it's unreasonable to say that we would have seen this result. So ultimately, Jason, the big point here is that there's a lot of noise about tariffs. There certainly is going to impact some companies. It's going to impact us as consumers, perhaps. But when it comes to stock market results, a lot of what is to be expected has already been priced in. And if the markets were to move, it would be for something unexpected at this point, which is unforeseen by definition.
So if I continue that thought process just a little bit, for, I don't know, it seems like quite a while now, we've heard the word recession, 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 right? It's coming eventually. It's coming. People thought it would be tariffs. People expected kind of continued inflation to be something that would cause that, jobs, consumer spending, debt, et cetera.
Right.
What are you seeing in kind of potential recession signals? How should investors think about it? Because it seems like one of those things where we're always waiting for an event
Right.
to happen, and I guess you could go on waiting for just about forever.
Yeah. And I want to start with just that word recession. Similar to tariffs, it's a bit of jargon. And I think that the media has made it sound that if the economy doesn't grow for 2 quarters in a row, that somehow that is a recession and that's really bad and we should be really afraid of that. It's more complicated than that, folks. Since 1978, US Congress has delegated the responsibility of calling a recession not to the media, but to 8 academics. They're part of the National Bureau of Economic Research in something called the Business Cycle Dating Committee. They're not dating each other; it's just called dating committee. And these are the 8 academics. They're anywhere from Stanford and MIT, Northwestern, MIT, again, Cal Berkeley, Harvard, and Princeton. And these 8 economists were tasked to tell us when we are in a recession. And it turns out that the way that they decide that is not only by looking at the economic output of the country, but also unemployment. They look at industrial production. They looked at so many other variables, and one of them being the economic output. And they also sometimes use their own judgment to determine when the U.S. is in an economy, is in a recession. And if you look historically, since 1978, what you see is that the U.S. had experienced pretty much 6 different recessions. So it's good to know since 1978, we have had 6 different recessions. The average recession is about 10 months, and it basically denotes some level of economic downturn. And the worst 2 recessions were in the 1980s, early 80s, and the global financial crisis, the GFC. The shortest recession was in 2020 when we were only in recession for about 2 months. So only 2 months recession, but the unemployment was so high and the economic slowdown was so significant that they basically called it a recession, even though it wasn't 2 quarters. So that's kind of what the subjective nature of a calling a recession. So ultimately, what does it mean to you? Listen, a recession is an economic slowdown, and that's not pleasant. But there's a difference between the economy, what's going on today in the economy versus the stock market. They're related as they have to do with business, but they're not the same. And what's the difference? The difference is that the economy has to do with the current level of economic output, unemployment. Our bonuses are tied to how well the economy is doing. So in a way, the economy is impacting our paychecks right now. If I'm a business and I'm not selling enough, well, that's going to impact my earnings today. If I'm not getting a bonus because things are not going well, that's impacting me today. If I get laid off, it's impacting my paycheck today. So the economy, if you want to think about it, is about our paychecks today. The stock market is about ownership in companies. And the value of the ownership in any company, in any business, is that I can partake into those earnings for years and years and years to come. So whereas the economy is about our paychecks right now, the stock market is about our paychecks from the future. That's the difference. And if you want to think of an analogy, some of you folks on the line might recognize this as being a film strip. Some might know what is a film strip. I have an iPhone or an Android. So if you think about the economy, it's a snapshot, it's a frame, it's a scene of what is going on at the moment in 2025. But in the life cycle of a company, this is one of the many, 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 many scenes. And the stock market is a much longer running movie, which is, and 25 is just one of the many scenes. And if you want to know how long is this movie being played, well, there are companies that we know and love that have been around for over 100 years. Exxon on their website has a list of all the cash payments they made to investors going back to 1911. So that's why I think it's important to know is that the economy is about our paychecks right now. The stock market's about a paycheck from the future. And because the paychecks are in the future, what the stock market's trying to figure out today is what should I expect this company to make? And it's adjusting the prices today. In other words, markets are forward looking. And to give you an analogy, Jason, let's say it's a beautiful summer day, but you see clouds on the horizon, you get an app and you see there's, rain coming. Well, you're going to grab an umbrella. You're going to get ready before the rain comes. That's what the markets do. The opposite is also true. If there's a rainy day and you see the sun is coming, get the sunblock. And because of that, sometimes the markets might seem disconnected from reality. In 1980, we had a terrible economy. We had very high unemployment, very low economic output. As an investor, you just say, boy, this is a very severe recession. As we talked about, one of the most severe recessions. Why would I ever want to put money in the market? Well, it turns out that in 1980, this horrible economic year, the S&P was up 32%, more than 3 times the long-term average. Why? Because perhaps the market was pricing in the good days ahead. The other very severe recession was in the financial crisis. 2009 was considered to be the worst economic year probably since the Great Depression. All the foreclosures, everything. As an investor, you might think, "Boy, am I nuts? You want me to put money in the market? Look outside the window. It's horrible." And yet in 2009, this terrible economic year, the market was up 26%, perhaps seeing the light at the end of the tunnel and pricing it in ahead of time because the markets are forward looking. And the last recession, 2020, even then, the market with the pandemic and all that was up 18% for the year. And I'm not saying that you should cheer up for recessions. I'm just saying that I would not make a decision about investing in the market or not based on the economic output of the country, because you're going to get paid in a stock for so many more years down the road that ultimately what happens in the next year or two in the grand scheme of things, it might not be as significant as how we feel economically at the moment.
Appreciate that. Um, Kind of staying along similar lines. Once again, trying to be positive here, but we have to reflect on some of the negative things that happened during the quarter. Obviously, global trade has been an issue.
Mhm.
We've seen national debt increase. We've even
Yep.
seen a downgrade in our credit rating as a country. There's a lot of talk now about the decline in the dollar. And we've had questions come in about its status as reserve currency for the world and the impact to a declining dollar. Maybe you could kind of take us through what that means and the implications of that moving forward.
Yeah, for sure. So let's spend a few minutes on the dollar because it is fascinating. And it kind of goes back. Jason, I was with my kids not too long ago, actually a few years by now, in Denali, in Alaska. And when you go on the map, it says Mount McKinley. There's a reason I'm kind of mentioning all this. And it had to do with the disconnect between the locals calling it Denali and on the maps being called Mount not being called Denali, on McKinley. So why is that? Well, it turns out that back about 100 years ago, more than 100 years ago, there was an election in the country. And one of the candidates was McKinley, and the other one was another candidate, who I don't remember his name. McKinley was promoting the idea that gold should be the precious metal back in the dollar. The other candidate suggested silver. And this prospector, who is also a cartographer, basically said, well, I'm a gold prospector. And even though McKinley never set foot in Alaska, let's just name this mountain McKinley because maybe that raises the visibility and maybe he gets elected. And he did get elected and then assassinated. But in the process, gold became the precious metal attached to the dollar. And for the longest time, I do believe that that gave people confidence that the dollar has value, the fact that it's backed by a precious metal. And that was the case for a long time, decades, up until the late 60s, when economists started to see that, boy, we have more people in society, the economy is getting bigger, and we're just not digging up enough gold. So what to do? Because we need to print the dollar bills so the economy can keep growing. And in August of 1971, President Nixon goes on TV and he tells the world that as of today, the dollar is no longer backed by gold. That as of today, the reason that we have faith in the dollar is because we all believe that the government will be responsible and it won't overprint. They won't run the printing machines day and night with no backstop. And you can imagine there's a bit of anxiety. It's like, wait, we're going to trust the government that they're going to be responsible with the printing machine. And that's why he imposed some wage and price freezes that he couldn't increase them. And in the early stages, it turns out that in the 70s, we did have some inflation. We did have the people like a little shaky about the dollar. And the primary reason for that was that the responsibility of printing dollars, it is not with the government. It is actually with the central bank, the Fed. And in the 70s, the Fed chairmen were really trying to align their views with the political movement at the time and the political interest, and they were kind of wishy-washy in their policies. Now, in 1970s, late 70s, early 80s, a new Fed chairman by the name of Paul Volcker, he came along and he said, no more monkeying around. From this point on, the Fed will be fiercely independent and it will never make decisions based on political will, but rather what we think is right from a data perspective. And since the early 80s, the Fed has been the entity that is actually printing money, not the government. And I would say that since the 1980s, the average inflation has been about 2 or 3%. The dollar has become the most preeminent currency in the world. But all of this because we all have faith that not the government, but the Fed is independent and it will make decisions based on what is right. And that has been the case. And if you look at it right now, the dollar is the most sought after currency in the world. And because of that, the dollar has also become a reserve currency. And what it means is that other countries are kind of holding dollars. And with the retrenchment from trade and with a lot of other things that are going on, perhaps people are saying, well, is the dollar losing that stature in the world? It's possible that at some point it might, but not at the moment. Not at the moment. Right now, the dollar is roughly about 58, 60% of all the reserve currencies in the world. And if you compare to about a decade ago, it was like a 64% or so. So it's roughly the same where it was, not much of a change. And in the short term, Jason, I personally don't see anything imminent to replace it. And that is for three different reasons. Number one is that today the dollar is still the most trusted currency in the world because there is no credible alternative. If you're not going to buy into the dollar idea, what other currency is today that people like it? I just came back from Fiji, and just for kicks, I exchanged not just dollars into Fijian dollars, but also into rimbis and euros. And I could go to any store and pay them in Fijian dollars or US dollars. Nobody had a question. Like, yeah, great, I'll take that. When I try to pay in rimbi and euros, they looked at me as like, is this candid camera? Like, no, I'm not kidding. I'm not taking this. Give me dollars or Fijian dollars. So people trust dollars. That's around the world. There's no other currency that even get close to trust that the dollar has. And because of that, I think that roughly about 90% of all foreign exchange in the world involves dollars. Because that's what people want. A merchant in Colombia dealing with a vendor in Italy for coffee, not other things. That's what they all prefer, dollars. So that's the first reason. There's no other credible competing currency. Number two is that the financial pipelines of the world are built around dollars. So you'd have to build a competing payment system around the world that is not built around dollars. And again, even if you do it, who's going to use it? But nobody has tried to build that. And when people are talking about the Chinese trying to do it, it's such a minuscule part of the global trade that it's just not really worth really emphasizing. And number three is that when you think about the reserve currency, countries don't just stash dollar bills in their vaults. It would be silly because they want to make money on that. So you need something that would make you money in that currency, something that is stable, something that is liquid, that you can turn into cash, and something that is trustworthy. And it turns out that the bonds issued by a government are hugely important. And as of last year, the US issued roughly about $2 trillion worth of bonds. I think the Europeans roughly about 1 trillion, so half. And the Chinese, I think when you look at their general bonds, were like 150 billion. So it was less than a tenth of the US bonds. So you also need to have the third piece, which is if I'm going to replace the dollar, what bonds are available for me to go buy that are liquid, they are safe, and trustworthy? And right now, again, the dollar and the U.S. bonds, the U.S. government bonds, still are pretty much the big game in town. So because of all that, I'm not saying that they couldn't change. Look at the British pound. At some point, it was the dominant currency. I just don't see anything imminent right now to say that all of these things have changed and now there's a new sheriff in town. Not at all. I think that despite all the challenges right now, that's the dollar is still very, very much the strongest currency in the world. And the fact that it's lost value relative to other currencies, that's a reflection of so many variables, and it's not the first time. It's happened over and over in the past, and that's just the cycle of the dollar getting stronger and weaker.
Yeah, I appreciate that insight. It's always interesting to hear your perspective on topics like that, which you know don't get brought up a lot except in times of crisis. So
Yeah.
I appreciate that perspective. You did mention gold when you were
Mhm.
talking about the dollar, and gold is a question that I think a lot of advisors have gotten from clients this year. Kind of thinking about gold being a place to go in periods of uncertainty or as a hedge against inflation, et cetera. And we've seen gold actually perform recently. It's at all-time highs now. And so I think people are asking a lot more questions about gold. And is it time to actually go back to the old faithful metal and put it in our portfolios?
Right. I think gold is part of a diversified portfolio because if you look at a company like Newmont Mining, they're mining gold, and this year they're up about 58%. So it is part of your portfolio. The question is, do you want to go beyond that? Do you want to just buy gold by itself? And the view that we have is that when you look at investing, you can look and say, what should I expect from that investment? And one way to evaluate that is value. And is it a good deal or not? And it turns out that that gold doesn't really have a productive economic activity. There's some being used for jewelry and maybe industrial production, but by and large, gold is more driven by sentiment, how people feel about it. And it's possible that the feeling might be great, and we've seen it this year. Yet over the long run, when you look at the data, gold is actually not a good hedge for inflation. Since 1980, we talked about 1980 to 2025 or 2005, that's when I remember looking, there there was a stretch of 25 years when gold did not increase at all in value. The beginning value in 1980 and the value in 2005 identical. 25 years, and I'm not. The S&P had shot to the roof by then, but inflation also doubled. Prices doubled, and yet the dollar was not a hedge. So if you're concerned about inflation and you want to hedge, I'm not sure that gold is the best. There are much better ways to hedge against inflation. The two that come to mind, if you look longer term inflation, look at companies who are in the stock market. Because if prices go up, well, guess what? These companies are the ones charging us more and their value increases. So stock, intuitively and looking at data, they are a pretty good hedge against inflation. But the other one, if you're really concerned, turns out that the US government has a type of a bond. And that bond is special, and it's called a Treasury Inflation Protected Security because its value adjusts with inflation. As the inflation goes up, so does the value of that bond. So you're always covered. Every single minute you're covered because that adjusts with inflation all the time. So if you're really concerned about it, I think there are better tools than gold. 2022, we had a huge run up on inflation. Didn't do anything for gold. Gold was actually down that year. So be careful what's being sold to you. A lot of marketing folks are trying to sell fear, saying, hey, the financial system's going to collapse. Buy gold so you can save your family. Well, I'm not sure I was going to save my family. Like if I need milk, what am I going to take the gold bar and start shaving a few things to get milk? I'm not going to do that. So I'm not sure exactly how it helps. Throw it at people as they come at me. If you're really concerned about that, I think, again, there are other tools that are better for the job.
Yeah, appreciate that. I know it's been a more popular topic in the press on television, and certainly we get questions about it. So appreciate that perspective.
But I got to tell
Um,
you one quick thing. It is
yeah,
the marketing machine of selling fear. And it's hard to resist because they're so good at targeting your emotions. You feel like I need to do something to save myself and save my family. And it's so disingenuous and it pisses me off to no end because it is making people feel anxious. It is for no good reason. And it's because they're trying to sell them a product that's not even necessary for them. And that's really, to me, disturbing, that the fear machine that the marketing is doing to people.
yeah, and that's why I'm so thankful that in my career I found an investment philosophy and strategy like this that we were fortunate enough to meet folks like you and Dimensional, where there's just logic and science and research behind it versus the kind of that fear and greed push and pull. Um, probably should have brought it up earlier in the conversation as we were talking about stocks. We forgot the other side of the portfolio and bonds. Um, speaking of bonds, I think, much like all the projections and prognostications that people make, we've been waiting for interest rates to come down and, the Fed to do something there. Maybe take us through a recap of bonds and what's going on with interest rates.
Yeah, so when it comes to bonds, I think that we paint that brush of bonds and interest rates, and bonds are a form of a lending. If the government wants to borrow money, they can go to Jason and say, listen, I'll write up a contract. I'll specify in that contract an interest rate that I pay you for how long I pay you the interest rate, and at the back end, I'll give you the money back. And one of the most important features of a bond is how long before you get your money back, which is also called maturity. And it turns out that if you actually do some research on this relationship between the length of a contract or maturity and the interest rate that you receive as an investor, also called yield, there's a relationship there quite interesting because if you're going to lend the money, let's say to the government for 30 days, which is a very short time, in a month you get your money back plus interest. Historically, investors didn't get that much because it's very short term, it's low risk with the government. But if you're willing to give the government the money for a year, well, your money's locked up for longer, and investors historically have expected a bit more. If you give it to 5 years, you once again expect a little bit more in compensation for your money being tied up there for a while. And that was also the case for 10 to 20 years, you would expect a bit of a higher rate. So historically, we've seen this relationships that's called the yield curve, and that's sort of the normal way in which it operates. And the maturity really matters. So today, if you look at the performance of bonds, what you see is that the bonds that are in the neighborhood of maybe 1, 2, 3, 4, 5 year, relatively shorter term, for the year, they're up about 2.5%. So that's been the case for these bonds that are on the short end, let's say below 5 years. Above 5 years, you've seen roughly about 4.5% returns on those bonds. So almost twice as much. So it is important to know which bonds are we looking at, and that's a determination that an advisor might make. But I did want to draw the distinction. Not all bonds are the same. A big important determination is the length of the contract or the maturity before you get your money back. Now, starting in 2022, for a while, we had a bit of an unusual but not unprecedented situation where these very short-term rates skyrocketed from zero to about 5.5%. Not as much as the 80s when it went from 0 to 18%, but quite significant. But the other thing that was unusual, yet not unprecedented, is that if you lend the money to the government for a year, you would have gotten paid less than a month. If you give them the money for 5 years, even less, and that was the case for 10 to 20 years. So we still had that connection, what's called the yield curve, but this was what's called inverted because it was a bit upside down. And that was the case in 23. That was a case of part of 24. And the reason I want to bring this is because so much is being talked about the Fed, the Fed, the Fed. Well, it turns out that the Fed primarily impacts rates that are associated with these short-term maturities. 30 days, for example. And in September of last year, the Fed started cut rates about 3 times. So these rates dropped. And the implication of that was twofold. One, if you're a business who needs to make payroll and takes these short-term loans, like commercial paper type of loans, that's a good news for you because you don't have to pay as much as interest. On the other hand, if you were invested in CDs from the bank, a certificate of deposits, they are required to buy these short-term instruments. And as the rates came down, so did the yields on these CDs. So you might have seen that the CDs don't pay as much. That is because the Fed is primarily impacting these shorter term rates. Now, what about the longer rates? Are they also impacted by the Fed? And this is where it gets interesting because, for example, you look at the 10-year US interest rate on government bonds. Well, in the fall of 2023, it was about 5%. So that was kind of the roughly at some point it hit 5%. And by August of 2024, and I pick August because that's a month before the Fed started to cut rates. So there was no movement by the Fed in August of 24. This rate had come down to 3.6%, despite the Fed doing nothing. It had a mind of its own. And then by the end of 2024, after the Fed cut the rates 3 times by about 1%, this rate actually went up to about 4.4% towards the end of 2024. So a very different dynamic that seems to really illustrate that the longer term rates are not really being driven by the Fed. They're driven by something else. And these rates are actually really significant to a lot of you who might be on the call because the CDs are impacted by the short-term changes. These longer-term rates, let's say the 10-year rate, if you look historically at what the rate was going back to the 1970s, and you overlay the mortgage rate, what it becomes really apparent is that the mortgage rate is not driven by the short-term rates, but rather it moves pretty much in lockstep, and it's the foundation of the mortgage rate. And that is not driven by the Fed. As I said, it's not. It has a mind of its own. So the question is, what might drive these longer term rates if it's not the Fed? And when you look at it, there are a variety of factors, but in my opinion, one of the primary ones is what do I expect inflation to be? Because if I'm going to lend you the money for the next few years, I want to at least be able to buy the same things. So we talked about September when the Fed started to cut rates. Well, at that point in September, the average expected inflation over the next few years in the US was about 1.9%. That was the looking forward inflation that was expected by market participants. And that's in line with the Fed expectation. But by February, we did see that the Trump tariffs were kind of coming to play and so forth, and the expectation had increased by about 0.7%. And as the expected inflation increased by 0.7%, guess what happened to the rate on the 10-year treasuries? They moved up by roughly 0.7%. And guess what happened to the mortgage rate? It went up by roughly 0.7%. So if you're thinking about maybe buying a house or taking a mortgage, I got to tell you, folks, it is not about what the Fed does because these longer term rates that drive the mortgage rates, they're much closer impacted by the expectation for inflation than by the Fed. So we're giving the Fed a little too much credit because they're not impacting all the rates. But the last thing I want to mention also is something that I've heard a lot, Jason, which is the rates are so high and they must come down at some point. And if you, again, take a look at the visual of the interest rates over the past 60 years, we are at 4.2% as of the end of June, not just a few days ago. And the question that I have for folks who are watching, who are looking at this, does it appear visually that we are towards some super high level of rates that we haven't seen? No, not at all. Then why are we so keen on saying that the rates are so high? And to me, it is behavior because we have a recency bias. Even though the long-term average has been about 6%, 5.9% over the entire period. If you look at the last 15 years or so between the financial crisis and when the inflation hit us in 2022, the average rate on a 10-year treasury was 2.3%. 2.3%. Before that, it was 7% before we had this lower one. So the question that I have is, what does appear to be more of the unusual or the anomaly here? The 6% long-term average or the 2.3%? And to me, we had two major events between the financial crisis and the pandemic, and the rates were kind of unusually low. And the way that I think about it is pretty much like in Chicago or Michigan. If it's January and it's a beautiful day and you can go out in your t-shirt, great, enjoy it while it lasts. But don't throw away your coat. Don't expect that it's going to be the norm. It's just not. It just happened that we enjoyed at very low rates. But again, visually, do I really expect that to go back to 2%? It's hard to tell because we are well above the average right now. And what it would take to go back to 2% perhaps would be some other major event in the world that might not be super pleasant to all of us. So because of that, Jason, I don't really I don't really know where the rates are going, but my just visually speaking, I'm not sure that I would expect them to go back to 2%. I think that not that the ship has sailed, but it's not really realistic to believe that. No reason
We
to believe that.
yeah, we've only got a couple minutes left, so I'm going to ask for kind of a speed round question
Yep.
here, because it's certainly on the minds of a lot of folks on this
Yep.
webinar. Just geopolitical risk seems to be tensions seem to be higher than ever. We've got Israel, Iran, the U.S. involvement, obviously ongoing wars in different parts of the globe as well. How do we see that impacting the U.S. markets in general? Any thoughts on kind of the geopolitical risk that we're seeing right now?
Yeah, for sure. So just a quick speed on that. Whenever something like this happens, it's very emotional, and it all hurts us. It pains us to see people running in shelters and all the devastation. Turns out that the market has a much more pragmatic look at what's going on. And the question that the stock market's asking is, what is the impact on potential earnings of companies because of what is going on at any one moment in time? So how is Facebook going to be impacted by Iran being bombed? How is Coca-Cola or Buffalo Wild Wings, whatever company out there, how will they be impacted? And quite often what we see is that even though there's a strong emotional response to that, markets are not really that impacted because the company's earnings are not that impacted by what is going on. So I'm not sure how much Apple sells in Iran or Gaza and so forth, but the reality is that what is going on there at the moment, it's quite isolated. And you can ask the question, well, what if things get out of control? What if we get through a really bad period? And to me, when I look back, the worst period that I can think of, and talk to my mom about this, is World War II. And if you look at World War II, and I thought it might be instructive to look and see, what if we actually go from something that's regional to something huge? What does it mean to your money? Well, in 1939, Germany invaded Poland. And if you're an investor and you say, boy, this is bad, this is going to be really bad. And then you meet with Jason and Appella and they say, no, you should stay invested. And you're like, are you crazy? Look outside the window. There are bombs and tanks and so forth. But somehow they managed to keep you in the market in the S&P 500 through August of 1945 when the war was over and Japan surrendered. Well, it turns out that a dollar invested at the beginning of this period would have pretty much doubled until the end. So it's a pretty remarkable growth in a dollar. And obviously the U.S. was attacked in 41 in December. So if you look at the full years of U.S. engagement, 42, 43, 44, 45, every single year the market went up. It's nuts. And one of the cynical conclusions is that, hey, war is good for business. I don't think that's the case. I think, again, supply chains, demand, it's horrific. What I think it's more reasonable to say is that in free markets, companies will find a way to navigate whatever is put in front of them. So in the case of World War II, what happened was companies that used to make cars like Cadillac or Ford or you name it, they actually stopped making those cars and they adjusted productions based on what was needed. And they put a Cadillac engine into a tank, and there was a Cadillac tank. I'm not sure it had leather seats and power windows, but that's a Cadillac tank, and they sold it to the government. So in free markets, companies will adjust to whatever is going on at the moment to navigate those times. The Jeep that we know today, it's got its roots in World War II. That's when Willys was tasked to produce them, and that's what came out of the Jeep. That's where the Jeep came from World War II. That's because there was a need and there was a company that went out there to satisfy that need. And we saw exactly the same thing in the pandemic, where Ford was producing respirators and masks instead of cars. You had, aircrafts that were being used for cargo rather than passengers. Red Roof Inn offering, rooms for remote workers, and certainly Zoom. We all know that Zoom basically was a big had a big impact on us during the pandemic. So ultimately, Jason, my answer to that question is that the geopolitical risk has to be assessed in the impact that it has on companies' profits. Quite often, the market signal is that that's a painful war. It's just not really impacting the companies as much. And secondly, even if things get to a larger scale, which cross the fingers they don't get, it turns out that in free markets, companies will find a way to adapt and provide whatever is needed and navigate those times the best they can. Not every company, not every year, but it turns out that free markets to me is a response to and gives me the confidence that markets will continue to provide healthy returns for the long run.
As we wrap up here, I'm struck by all the things that we've spoken about and that you've educated us on. Geopolitical risk, wars, tariffs, credit downgrades, declining dollar, recession. I haven't said a positive word yet, but markets across the globe are up, right? And I think that's, a credit to, people who, stick to it, stay with their financial plan, stay invested through these seemingly turbulent times, because all five of those reasons would be reason enough for an investor not to be in the markets.
Yep. You're right.
So, I appreciate very much your perspective and education on all these topics. I certainly hope that everybody feels, despite all those kind of bummer topics that we just talked about, a little bit better covering the resilience of the markets, your portfolios, and the impact to your long-term financial goals. Apollo, can't thank you enough for spending so much time with us. This is my favorite hour of the year, so I thank you very much. We look forward to seeing you again at future events in person and online here, especially as we recap whatever the second half of this year looks like when we meet again in January. So really appreciate all your time and dedication to helping all of us.
Been great fun talking to you. Thank you. And be careful what you wish for. I might just come back.
Well, we would welcome that at any time. So, and to all of you, thank you for spending your evenings with us. We appreciate it very much. This recording should be available and posted in the next few days. Like I said, please share it. Go on to our events page at apollowealth.com and look for other events. And Apollo, we look forward to seeing you in the very near future. Thank you,
Bye bye.
everyone. Have a